Hello everyone, Manuel Sanchez here, and on behalf of the U.S. Grains Council and our members, I'd like to welcome you all to our webinar, our Trade Talk webinar here this morning. First and foremost, I hope this webinar finds you in good health and safety. We know that the dynamics of this COVID pandemic is affecting each and every one of us lives daily. The situation is still fluid and ever changing, but what is not changing, and part of the reason why we're here, it's our commitments to our markets here in Southeast Asia. And it's truly an honor for me and my team to be here representing each and every one of you. So before we get started, there's some household items that we need to cover. If you guys saw at the beginning, those of you in Vietnam, if you want to listen to this webinar in Vietnamese, if you could go ahead and click the interpreter button and select Japanese. Unfortunately, there was not a button for Vietnamese. So if you do that, the presentation will be automatically, simultaneously, I should say, translated into Vietnamese. Similarly, if you want to ask a question, all the questions should be guided towards the Q&A session right here at the bottom of your screen. You could ask the questions in Vietnamese and our translator will translate that to us directly as well. Keep those questions coming throughout the webinar and we'll have time to answer them during the Q&A section. So we're excited. We have over 300 people that have signed up for this webinar from across our region. We have quite a dynamic group of experts and presenters this morning. So we're excited to bring to you, the latest out of the US, referring to not only our current crop as Mr. John Greer, a farmer from Nebraska who also leads our Asia advisory team, and his daughter was presenting to you there in the earlier video, but also talk about our most recent crop that we harvested, which we've seen in recent months, a lot of that corn making its way into Southeast Asia. Vietnam in particular has been receiving a lot of that corn. Also Indonesia has a cargo on the water that's on its way, Malaysia. So we're excited to talk to you a little bit about that specific crop. And also, I'd like to announce sorghum. There's been a recent announcement that we can now ship U.S. sorghum into Vietnam. So we hope to cover a little bit of that as well during our presentation. From a U.S. perspective, our markets are open. Our grain exporting facilities, both private and public, are operating and continue to operate and serving markets throughout the world. So we're delighted to be with you this morning. And I take this opportunity to introduce Caleb Worth, our Assistant Regional Director, who's really been the architect of this webinar. So without further ado, Caleb.
Good morning and good afternoon, everyone here in the region and around the world. Caleb Worth here, Assistant Regional Director of the U.S. Grains Council. We have a fantastic lineup for you today, and I will have the pleasure of introducing you to our panel of speakers and moderating the Q&A end of the program. Please remember to submit your questions to the Q&A section of your screen so we can pick up and answer. Please remember to indicate which speaker you would like to answer each question. To begin our program, we will be hearing from Reese Canaday. Reese Canaday serves as a manager of global trade for the U.S. Grains Council. Prior to joining the council, Canaday spent 2 years in Amarillo, Texas, working for Atterbury LLC as a trader. In this capacity, he served as liaison between Atterbury's headquarters in Mexico office, and he specialized in feed industry, serving all customers in the states of Texas, Kansas, and Oklahoma. He has a storied history in the grain trade and has had experience working closely with foreign-owned companies with other feed operations in Texas. Reese's role at the council is to foster relationships in the U.S. and with global traders to further the export marketing interests of U.S. feed grains and co-products. Reese?
Thanks, Caleb. I appreciate it. Thank you for the introduction. If you could enable screen sharing, I'll get on and go ahead and share my screen and get the presentation up. Here we go. So as Caleb said, my name is Reese Kennedy. I'm the manager of global trade for the U.S. Grains Council. Can everybody see my screen? Just want to verify. Here we go. Apologize for that. My name is Reese Kennedy. I'm the manager of global trade with the U.S. Grains Council out of the Washington, D.C. office. Today, I'm going to talk to you about our corn export cargo quality report. Some of you may be familiar with our harvest quality report that we put out every year. This would be the second report that comes out later. So when we look at our harvest report that everybody's familiar with, you're really looking at samples taken right here, which is the first point of sale into storage, into an on-farm storage or a country elevator. So that's what we look at in our harvest report. But what we're going to be looking at today is our export cargo report, and the samples are taken right here at the point of export. So keep in mind that between these two reports, there's quite a bit of movement that the grain experiences in going from on-farm storage to what we call a sub-terminal elevator, where they can either load rail or barges, and then down into an export elevator and out to you all, the international buyers. Some of you may have seen this before, but for those of you that haven't, I want to just clear up how we divvy up some of the data. We look at it by export catchment area. And what I mean by that is there are some regions in the United States that tend to run tributary to export points. Those export points that we see are New Orleans down in the Gulf, and that would be these states here in green that show propensity to come down in barges down through the Mississippi River and through our river system and come out through New Orleans. We have the southern rail area. This region really only applies to Mexico. These are rail shipments that would come across the Texas border and into Mexico, our trade partner to the south. Then you have this blue region here. This area runs tributary to the Pacific Northwest port system in northern Oregon and southern Washington. So there's quite a bit of issues this year with some of the growing conditions in this blue region. So certainly want to talk to you all about that and talk about the varying growing conditions around the country. It's very important to note that we had a very variable crop this year. Around the country, you'll see very different numbers. So certainly keep that in mind as you look at the data as a whole. When we look at the highlights, the main issue we had this past year is we had a very, very wet year. That wet year led to a shortened growing season. People were not able to plant as quickly as they would have liked, and we had to get the corn in a little later. So we saw quite a bit of moisture coming out of the field, which is a pretty good predictor for stress cracks. And we saw very high stress cracks this year, which then I think predicts BCFM fairly well. So we'll get into this in a little more detail, but certainly the story of this year is a higher moisture crop at harvest, which caused some structural integrity problems with the grain. When we talk about mycotoxins, we really didn't have as bad a year as I think most expected when it came to mycotoxins. Aflatoxin is something that's more of occurs more during a drought year, whereas I think vomitoxin or DAWN was going to be the main concern due to a lot of the wet weather that we had. However, we still saw 100% of the samples below the Food and Drug Administration advisory level of 5 parts per million. So I'm going to go forward quickly. Just want to talk about the grade factors and moisture. So that was the first thing that we look at. As customers, you buy a grade that may be number 1, number 2, 3, 4, or 5. I believe obviously what is most contracted around the world is number 2, with number 3 also being contracted in many markets around the world. When we look at the grade factors I want to focus on today are BCFM, total damage, and then moisture, which is not a grade factor, but certainly want to talk about it. BCFM, we did see some around a 7% BCFM, which is a number 5 corn, but again, that was max. We saw quite a bit of corn come into the number 1 range, which would have been above 2%. So the average was just outside of the number 2 specification, which is 3%. So we were just above that. But I want to keep in mind that some people do buy number 3 around the world. So if we're just above that number 2, I think that makes perfect sense for the shipments that have left the United States. Since other folks are buying number 3, it would push that average a little higher. Total damage came in at a number 1 grade at 2.9. Heat damage, a number 1 grade at 0. And then moisture, in the United States, we merchandise 14.5% moisture corn. That's a norm of the trade. It's something we've been doing for years. So we have to keep in mind that we're always, every year, going to get to this 14.5% moisture. So the higher we start, the more drying that has to occur to get down to that acceptable moisture level for sale in the international market. And with that come the problems of stress cracks and this higher BCFM that we may have seen in the past. Looking at BCFM, we see the highest BCFM in the Pacific Northwest region. That's not uncommon. I think every year we do see that, primarily because they have the shortest growing season year over year. Freezes are coming. People need to get in the field, get their corn cut, and it shortens their growing season, making, again, more artificial drying, more cracking, and more BCFM at export. As far as where the number 3 exports come out of the country, they do tend to come out of the Pacific Northwest when people buy number 3 grain. So this 3.8 really isn't very alarming when we consider, I think, what people may have been expecting. On average, we were certainly the highest we've ever seen in the 9-year history of this report, but it's nothing, I think, percentage-wise that we were expecting based upon what we were hearing during our harvest report. So we use the harvest report, particularly for BCFM, we use the harvest report to predict maybe the severity of BCFM at export. And this year, it looked like our prediction was going to put this number around 4% on average, but it came out to 3.1. So certainly a testament to grain elevator operators around the country and agribusinesses around the country that they've been able to manage this potential problem that we had looming. So definitely a good sign there. When we look at chemical composition, we're looking at the protein content, the starch content, and the oil content in grain. In the United States, corn really has been the innovation going into seeds and everything like that surrounding corn have really been to push toward more starch content. So starch content is and extractability, starch extractability are certainly what people are looking for in the U.S. and are planting those varieties of corn. So looking at protein, we had an average of 8.3, which was a bit low on the year. We had a little higher oil content than we've seen in the past. And then starch was roughly around the average we've seen over the past 4 years. There was a drop in starch about 4 or 5 years ago. And since then, we've hovered between the 72 and 73 range on starch. Next, I want to move to the physical factors. And again, I know this seems fast, but hopefully we can get to everything during the Q&A. If you have any questions, please feel free to ask them. Looking at our physical factors, again, stress cracks and stress crack index are 2 really great ways to predict BCFM. We've noticed there's a strong correlation between stress cracks and stress crack index in the harvest report and then BCFM at export. So it tells us, this grain, it predicts how brittle the grain will be as it moves through the export process. So when we look at stress cracks, we had a higher year this year than we have in the past. We had an average of 11% stress cracks, and even some samples as high as 47. That's not to say that we didn't see some, obviously, that came in with none. But the average was 11. Standard deviation of 7, I think, shows just how variable this factor was as we moved around the country and had different growing conditions during the year. So in looking at stress cracks, again, the PNW or Pacific Northwest had more issues than other areas, strictly due to the fact, again, more artificial drying caused higher stress cracks. So again, we're looking at breakage susceptibility or brittleness of the grain. So yes, this was higher than the 5-year average, but certainly not as bad as we may have seen in the past. 2013 and 14 had quite a few stress cracks in the grain, as well as 2014, 15. So it's not to say that all is lost. There is certainly still quite a bit of quality grain and non-brittle grain running around the United States. When looking at mycotoxins, I want to be very clear that our mycotoxin testing in this report provides an assessment of the presence of aflatoxin, DON, or vomitoxin, and fumonisin in U.S. corn as it reaches export points early in the marketing year. 431 samples, or all of the samples, are tested for aflatoxin, while only 180 samples are tested for DON and fumonisin. This report will only report the frequency of detected elevated levels of mycotoxins in export samples, and we're only reporting positive results above the lower conformance level, which is essentially just judges the sensitivity of the test. So, we say if anything is below 5 parts per billion aflatoxin or below 0.5 parts per million vomitoxin and fumonisin, then we will say that it is free of those things because it is below that threshold. Looking at key aflatoxin levels, your main concern is going to be dairy, since the aflatoxin passes through to the milk and can pass on to humans. So the main sensitivities are for dairy animals. The FDA, the Food and Drug Administration in the United States, recommends no higher than 20 parts per billion in at least 50% of the diet. The least susceptible to aflatoxin concerns, according to the FDA, are finishing beef cattle. Aflatoxin is something that happens in drought years. So this year, we really didn't see any kind of aflatoxin like we may have in the past. Normally, aflatoxin is not a problem, save the 2012-2013 drought season. And this year was no exception. We had quite a bit of rain, which probably made it less susceptible to aflatoxin than even just the average year. And I also want to remind everyone that if you are buying grain from the United States, our Federal Grain Inspection Service does certify every single shipment that comes out to be less than 20 parts per billion aflatoxin. So do keep that in mind, that we do have certifications that do that simply as part of buying grain from the United States. So for that reason, we rarely see aflatoxin in any kind of export shipment ever. When looking at DON, or vomitoxin, swine are the ones who have famously given it the name vomitoxin due to their propensity to vomit if exposed to high levels of DON. So swine, definitely your biggest concern, while chickens and dairy cattle and ruminating beef rations are certainly of least concern. That said, I do want everyone to pay attention to this 50% numbers. So this is to say that you're allowed to, or according to the FDA, you can serve swine up to 50%. Up to 50% of the ration can be corn up to 5 parts per million vomitoxin. So keep that in mind. If you do examine any kind of grain that you receive from anywhere in the world, you should always be examining your grain as it comes in. If you see any kind of elevated DON levels or elevated mycotoxin levels, all is not lost. That corn can be blended into a ration. There are ways to make that work. So keep that in mind. Again, no matter where you're buying from, you should always know the mycotoxin content of your grain. And if that's the case, you see mycotoxins that are too high, just remember that it can be mitigated via strategies. Looking at DON, this year we did have a higher prevalence of DON than the past, but nothing was really alarming. We didn't see anything over that 5 parts per million that can be concerning in swine rations. We did see a little bit of elevated cases in the 0.5 to 1.9 parts per million range. Again, as far as whole grain is concerned, you're far away from that 5 parts per million danger zone for swine and other animals. So I don't think we've seen anything to be worried about when it comes to whole grain going into rations. Now, I know there are a lot of buyers of DDG. In this range, or at least on the upper end of this range, some of this grain will run the risk of tripling its mycotoxin content and then being over that 5 parts per million. Now, despite that, I just want to say that ethanol plants around the US test for DON as grain comes in. They test for aflatoxin. They test for fumonisin. They're very aware that DDGs are very susceptible to high levels of mycotoxins. So they're always testing the grain as it comes in because they want to make sure they can merchandise their DDGS safely to their customers around the world. So I know that there may be a little bit of concern that some of this mycotoxin content could trickle into DDG, and the same thing we'll see with fumonisin. But again, ethanol plants are mitigating this at all times, and that's not just this year. That is all years around the clock. They're testing for mycotoxins to ensure they have a safe feed ingredient to merchandise. Fumonisin, this was our first year collecting data on fumonisin. Thanks to you all, you were able to give us some insight and let us know that fumonisin is important to you. So if you have any grade factors or any kind of physical factors or mycotoxin tests that we're not doing, please give feedback to Manuel and Caleb, and we can include those for you. So when looking at fumonisin, I think the main diets that really start to be affected is right here at 20 parts per million when you look at swine and aquaculture. Again, that's 50% of the diet. So if you're stuck with grain that's a higher fumonisin level, there are strategies to be able to get rid of it effectively, economically, and without damaging your animals. When looking at our fumonisin testing, most of the results, 93.3%, were below the 5 parts per million FDA guidance level. And we really didn't see anything that hovered around that 20 parts per million that could be of concern. We did see some here in the 5 to 10 parts per million, which may be some concern in DDG. But again, ethanol plants are testing. A lot of you I know contract this as well. You contract fumonisin and vomitoxin specs. So be sure to continue doing that and continuing to protect yourself from any potential mycotoxins coming in on DDG. I'm not saying it's common or that it's going to happen, but we certainly always want to know what we have so that there are no surprises when feeding it. Now I'm going to change gears from the corn quality report and briefly talk to you about the corn planting situation as far as next year is concerned. When we look at last year, as I said, we had a very late planting. So we look at this time last year, we were only 44% planted. This year, we're 80% planted, not only well above last year's planting, but also well above the 5-year average. People last year obviously had a very tough year when it came to being able to plant and harvest both. So they remember that, and they are ahead of schedule. So they are pushing as hard as they can to be able to plant and have what's looking like today a potential record crop, depending on how the weather treats us throughout the year. Now I want to briefly talk about sorghum. I know there are some new opportunities in Thailand or in Vietnam for sorghum. We just got the pest risk assessment passed there, so certainly going to be looking at some potential opportunities in a lot of sectors there in Vietnam. This area planted, this is in million hectares, so that's 2.347 million hectares. That number is from the May WASDE report. However, the data is really as of March 1st. And since March 1st, the price of sorghum versus the price of corn, that spread has widened considerably due to some Chinese demand for sorghum. So that said, we can probably anticipate this area planted to increase considerably, and it would probably take acres away from corn. Now, sorghum is kind of a smaller crop and only produces around what they're projecting today, 9 million metric tons. I think more estimates would probably suggest we can get closer to 10 million metric tons because of this increase in area planted. But a lot of that is going to have to do with the yield, since sorghum is a dry land crop. It is rarely, if ever, irrigated. So the weather can have a much bigger impact on yield than, say, in corn. So this yield number certainly is affected by weather more than other coarse grains. So again, we anticipate perhaps 10 million metric tons of production, and so certainly a big exportable supply. I don't think there will be a whole lot of use of sorghum in the United States this next year, so a lot of that will run into the export system simply due to the really cheap price of corn in the U.S. today. When we look at sorghum harvest, some of the logistics, we have this early harvest that occurs down here, but it principally occurs in this region along the Texas coast and down in the Rio Grande Valley. So that'll come off in July. And then after that, we'll have what we call the late harvest, which is principally located in this corridor right here. They're from West Texas up into Western Kansas and then also into Central Kansas. That would be sort of the sorghum hotbed growing area in the United States. And that harvest will begin, late September into October. That's when that harvest will begin. So when we look at our early harvest, this is the Texas harvest that's coming in July 2020. So this will come here in about a month and a half. This is from this year's crop, these photos. These are taken down by the Texas Gulf. I got these off Twitter yesterday, so these are very recent photos. The crop is looking excellent in that part of the world. They just got a shot of rain too, so I really think we're gonna have a great crop and some great yields coming out of South Texas. And now all we have to do is hope that the weather cooperates for the later harvest in West Texas and Western Kansas. So with that, that's all I have. Again, I know it was a bit rushed, but if you have any questions, I'll be happy to take them during the Q&A. I want to thank everyone for your time, and I want to thank Manny and Caleb for putting this on. Thank you all very much.
Thank you, Reese. It sounds like this crop is better than expected, especially in some catchment areas, and could be a great opportunity for customers out there. I do want to take the opportunity to point out our Q&A application. At the bottom of your screen, there should be a little icon that says Q&A. You can click on that and post your questions. We will see that, and we will try to answer each and every one of those questions at the end of the program. I can see there are attendees who have posted already, so thank you for that. Please continue to do so. In the second portion of our program, we'll be hearing from our USGC member exporters, Cargill and DeLong Company. They will give us a little bit of color on the current market conditions today. First up, we have Tyler Schultz. Tyler Schultz is a senior merchandising manager of export corn for Cargill. In this role, he trades U.S. Gulf corn as well as manages the day-to-day commercial activities of Cargill's 2 grain elevators in New Orleans. His previous roles include soybean merchant, commercial manager of softseed facility, a merchandising manager of export and global soybeans. Tyler has spent time at Cargill's facilities in Iowa, Missouri, North Dakota, Minnesota, and Geneva, Switzerland. Tyler grew up on a dairy farm in Minnesota and graduated from Hamline University. He is married with 3 kids and enjoys skiing, biking, and golfing when he's not trading. Tyler, I'm going to hand it over to you.
Great, thank you. I am going to attempt to share my screen. Good morning, everybody from Minnesota. I was lucky enough to get my 3 kids to bed before this started, so hopefully they cooperate with me. Let's try this. Okay, I think we're good. Can you get a thumbs up, Caleb, if we're good? Can you see my screen? All right, great. Okay, so quick agenda. We've got 10 minutes here. We're going to go through as much information as we can, and then I'd be happy to answer any questions that come up in the Q&A. So we'll briefly touch on the U.S. S&D. We just had a USDA report recently, so we'll talk about that. We can talk about global production, what we see around the world, where crops are growing, where we see some crops may be going down. Talk about factors to watch going forward for price, both futures and basis. I can touch on what I think Cargill's trading range for futures will be, and then talk a little bit about quality and logistics. As the folks mentioned, I manage our U.S. Gulf facilities, and there are some unique things that will be happening this summer that will impact logistics that I think are important to talk about. So we'll jump into it. So here is a lot of numbers. I'm sorry. This is the USDA report from May, the WASDE report. I tried to circle the ones I think are most important. So on the left side, we've got the 1920 S&D. And the number that got a lot of attention because of COVID-19 in the US is ethanol use. And I would say that the number that USDA came out with at 4.95 billion bushels was on the high side of what many people expected. Since this came out, motor gas demand has been better than most people expected, and I think people are starting to believe that this ethanol number SDA can be correct as long as there's no reoccurring issues with COVID. But driving is back in the U.S. People are driving much more, and that should mean better ethanol demand and better ethanol usage, and we're seeing that in the cash markets. There's many more ethanol plants starting back up. So
Hey,
with
Tyler,
that ethanol, yep.
Sorry to jump in here. We're gonna do a technical adjustment here. The participants cannot see your screen. If you could
Okay.
readjust it to presenter view.
Yeah, you bet.
Tyler, you might
Let me
be
know.
sharing your laptop, not your desktop, because it's currently.
Okay.
There we go. I think you're in the right place now.
Okay. Let's try here. How's that look? Is that better?
All right. Okay.
Okay. Sorry about that. So 1920 S&D, I think people have moved past it. We're going to have plenty of corn in the U.S., something between a 2.1 to 2.2 billion bushel carryout. The market's well aligned around that number. I don't think there's much to talk about there. All the focus of price and basis going forward will be new crop. The USDA initially used 97 million acres. I think that's very aggressive given some of the challenges we've seen with wet weather in North Dakota and in Ohio. So I think most in the market are using something closer to 94 million planted acres. So I think the USDA 2021 carryout of 3.3 billion is probably the biggest we'll see all year. I think the acres are too high and will probably be down at least 2 to 3 million. What we don't know, and what the great farmer who started this call talked about, is how great planting conditions have been. So we don't know what the yield will be. The 178.5 probably has plenty of upside if conditions stay as good as they are today. And we hope that that continues, because that should be better quality, as he alluded to as well. The other two numbers, or the other one number I guess I circled, was ethanol use for next year. So again, there's a lot of discussion about what ethanol demand will be. Is COVID-19 going to come back? Are we going to have another second wave? Is it going to be gone? You know, if we're past the worst of it, you probably can see some upside in this 5.2 million or 5.2 billion number. If we have another lockdown issue in the US, then that will probably be lower because people will be driving less. So I think most people in the market are trading something around a 3 billion bushel carryout because of lower acres. And then we'll have to see how the demand side of the S&D evolves with ethanol and with exports going forward. Looking at the global production numbers, just circled a few numbers here. So I'll give you cargos on the Brazil crop. We think the USDA is too high at 101 million metric tons. It's been very, very dry in the southern half of their safrinha crop area. And it looks very unlikely to us that we're going to be able to come close to that 101 number. We expect people to continue to reduce that number as they get into the field and find lower yields, especially in that lower half of the safrinha area, because of 20 plus days of no rain in their most critical time. So that should mean better demand for US exports, and it should mean lower demand for Brazil exports in the next, call it 8 to 12 months. And then on the right side, you can see the USDA is calling for a big, big increase in world production, but most of that is in the US. So 72 million tons of increase of production across the world, but 59 of that is in the US. And that crop is just getting planted. So there's lots of variability still in front of us, and we don't know what it's going to look like. Acres we already we think will be lower, but yield has the potential to be higher. But again, the world growth is really US growth, and that all still in front of us. So what could change things here going forward? So we talked a little bit about acres already. It's been way too wet. We're going to see prevent plants in both North Dakota and likely Ohio. How many acres of prevent plant happens is yet to be determined, but the incentive for the farmer via some government programs are there to not plant and expect to see lower acres because people put prevent plant acres into their government programs. Again, ethanol, nobody knows what driving is going to be in the US for the next 3 to 6 months. It looks good today. The recovery has been faster than most expected, but it's unclear how fast it will go back to normal and if we'll see a leveling off of something less than normal in the next 2 to 3 months. And then the other elephant in the room is China. China has bought 2 million tons confirmed from the US of corn. That's all, the first 2 shipments just shipped in last week. And then we expect the rest of it to be shipped between now and December. There's rumors every day about what China's going to do if they're going to buy more US corn. The incentive certainly is there for China to buy more. The import margins versus local prices are 70 to 80 bucks a metric ton. So as soon as the government gives the green light, I'm sure we'll see more demand, but it's just a matter of if the government gives that green light. So those are things that could potentially be bullish. On the bearish side, 80% of the crops planted in condition, so we are off to a good start in most of the growing areas. We still have, plenty of tension between the U.S. and China, both around trade and now around COVID-19. Who knows what that's going to look like? That seems to change every day as well, but that will continue to be a factor for our markets. And the other thing that gets a little bit less press, but is a big deal in our opinion, is how weak the Brazilian real has been. Farmers in Brazil are getting rich because of how weak their currency is. And so they're going to be incented to continue to plant more acres of beans and corn. So that's something to watch out for as we move forward if the US dollar stays strong. So here's our view. The next, let's call it 2 to 3 months look like. So this is July corn futures chart. Where do we see the range? I think with lower than 97 million acres, I don't know that we go back to $3. I think that's probably unlikely until we know more about pollination and what the total size and yield will be. Funds are also short, so that you're not seeing a lot more selling power from the fund community. And then the farmers aren't selling anything either. So what was announced today in the US is the farmers are going to get another payment from the government. That will keep them, they won't have to sell corn or beans to keep their cash flows moving. And so they'll take that money from the government. They can continue to be paid to sell. So we're not going to have farmers as a seller of futures either. So we think that probably means a limited downside, but upside is also limited. We're talking about a 3 billion bushel carryout for next year. That's too much corn. We need to probably ration, supplies going forward, and we need to do that via lower price. So I think we're calling $3, $3.50 kind of our inside range. Obviously, with weather in China being the big factors to watch going forward. But that's kind of what we're thinking in the kind of near to medium term. And then just a few miscellaneous notes. We talked about the crop conditions and the quality challenges. We're not expecting that to happen next year. This early plant is much, much better than last year. We're going to get a better growing season, just like Reese said. So those things are looking much, much better than last year. The U.S. Gulf River logistics will be complicated this summer. So anybody that's familiar with how the river system works in the U.S., there's these things called lock and dams, which regulate the water flow moving down the river. And those locks on the Illinois River will be closed for 3 months. So you'll effectively lose a third of the elevators that typically load corn on the barges for the U.S. Gulf this summer. And so that will force all of the supply need to come from the Mississippi River. So you'll be pulling more corn from a smaller area. So it could create some dislocation of barge freight, and it's something that we're not used to. So we'll be watching that closely. I can't say if it's bullish or bearish at this point. It's probably more bullish basis than anything, but we need to watch it, and barge freight will have a big impact on that as well. And then I alluded to this already, but farmer selling super slow. By our count, farmers are 10 to 15% behind average for this time of year. They don't need the money. They hate the price. They don't want to do anything. And so they're not selling much. So that's keeping basis elevated in the U.S. And I think that will continue for the next 30 to 45 days, unless we see a futures rally. That is all I had, and I look forward to questions from the group going forward.
Thank you, Tyler. Please contact Tyler and his regional team for specific inquiries, but we will hear more from Tyler at the end of the program. Next up, we have Brian Arnold with the DeLong Company. Brian is the manager of DDGS exports with DeLong Company and has worked for DeLong for 12 years. After graduating from the University of Nebraska-Lincoln, Brian began working for DeLong in 2008 to assist in the further growth of containerized feed and co-products such as CGM, DDGS, and soybean meal. Brian currently focuses on origination and sales of DDGS through DeLong's container loading facilities throughout the Midwest, destined for Asia, Southeast Asia, and Pacific Rim countries. Brian, I'm going to hand it over to you.
Good evening, everybody. I'd like to thank the U.S. Grains Council for hosting this and for inviting me to be a participant to speak on some of the impacts of the container industry here over the last couple months. And I will spend the majority of my time just talking about how, just some specific timelines of impact since Chinese New Year and since the experiencing coronavirus as it has spread throughout the world and throughout the U.S. So as I said, I'm Brian Arnold. I'm with the DeLong Company, and I'm part of our export sales group managing our distiller grains. Kind of the basis for our breadth in the market is we are the largest containerized exporter, and we export about 2 million tons a year by container. So to dive in here, I will talk about the container market post-Chinese New Year, because that's really when the U.S. started to, well, the world market really started to feel the impact of coronavirus. About the 29th of January, that's really when steamship lines began to send notifications that Chinese New Year holidays would be extended. And with that, there would be further delays of inbound goods and freight to the United States. Then we go forward a couple weeks to February 15th. The container supply is still very good in the U.S., and that still has allowed trade to continue. However, that was based upon the seasonal shift of the buildup of supplies just from that couple week holiday. But then we get to the 20th of February, and that's really when we start to feel the impact of that forward-looking trade flow as it's beginning to be reduced, and bookings are needing to be made 30 to 45 days in advance to secure space. We're also starting to feel the impact of freight rates beginning to increase from the steamship lines, as they themselves were not certain at that point what trade lanes they would be able to service and how they would fill their vessels going forward as the virus spread throughout the region. Now we get to March, and this is where steamship lines, they just begin omitting vessels. They stop, they've just pulled vessels from ports of call, and they have just left them sitting as they are trying to fill them with cargo as multiple regions throughout the world begin to go into lockdown procedures. Maersk, as an example, has voided 90 sailings throughout their trade lanes, and Maersk is the largest containerized carrier in the world, and they have a fleet of 665 vessels. So they had 65 vessels that were just sitting in this time frame. This is an example of the impact on the market. Now, this would be multiplied several times as you take all the carriers across all the trade lanes, whether it is Asia to the USA, USA to Asia, inter-Europe and Asia as well. Now, these void sailings, they've continued throughout the entirety of the time, March, April, and May. So currently what we're experiencing is this very tightness in scenario in the vessel space. to reach any specific destination and routing. And steamship lines are constantly adjusting and changing what they are allowing for in terms of vessel space for commodity goods, just because the U.S. is a consumer market. And if those consumer goods are not coming to the States or not leaving the Asian region where they are produced at, that greatly limits what our trade opportunities are for the containerized markets. In conversations with many of the steamship lines, and then just trade partners and lots of attendees here as well, we've began to realize that things are slowly starting to open back up. Tyler has pointed to that people are getting out and driving again. That's what we're just now starting to see that across the states. And we're waiting to see how that further impacts and enables trade to start to resume again as we start to receive those goods back to the States, and as trade begins to hopefully somewhat stabilize. You know, and Tyler spent a great amount of time, and he really did some fantastic work, you know, talking about what the production is going to be. I'm going to kind of highlight what has happened over the last 60 days. About March 15th, ethanol production at that time was forced to drop about 60%. So there are 200 ethanol plants in the U.S., just roughly from a production standpoint. So that dropped to about 90 ethanol plants that were in production at that time, just to give a rough number on it. You know, that caused DDGS prices to spike to all sectors by about $70 per metric ton, as the market really tried to adjust to what the impact would be of the possibility of an industry going to virtually no production. And it took an entire month yet of slowdowns, shutdowns, as ethanol stocks continued to build to reach a peak of 27.5 million barrels that were in storage within the U.S. This is about 3 million barrels more than had been the previous high of ethanol stocks within the U.S. And even currently today, it's been another month yet here at the 15th of May, and we are starting to see those stocks come down. They are about back to that 24 million barrel level, and this was the highest level, or previously the highest level we'd experienced. So we're back to a point of some stability, and you know, as we further reduce this stock number, as people get out driving more, and we have a little bit more hope that there will be some normalization within the market. It has not occurred as of yet, but we are starting to see some light that freight rates as well could start to come down slightly and get back to those levels that were pre-global impact. And that'll be another thing that we'll be on the lookout for, that will hopefully enable U.S. trade to get back to some of their previous levels, but also with the price competitiveness that should now be able by buyers to be enjoyed, reach new markets to a little bit further depth. As we look at, you know, your region, this region is highlighted here as the top containerized destinations. So with the lower prices of corn, DDGS, corn gluten meal, soybean meal, definitely on the thought of exporters and how we can reach the region. I really don't have a further information regarding the outlook, as it's still very uncertain, just hopeful that everyone is able to resume trade in a formal fashion. But with that, I will turn it back over to Caleb.
Thank you for your insights. Please contact Brian if you have questions about his offerings. In the next portion of the program, we will be discussing GAFTA contracting. To do this, we have Jay O'Neill. Jay O'Neill has 46 years of experience, although he doesn't look it, in the grain industry. Jay is the proprietor of H.J. O'Neill Commodity Consulting. Previously, Jay spent 12 years as a senior agricultural economist at the International Grains Program, IGP, at Kansas State University. Prior to that, he worked as a grain trader and a grain group manager for Continental Grain, Pillsbury Company, and the Ferruzzi Group, Bartlett Grain, and as a private consultant to domestic and international grain companies. Jay also publishes a weekly transportation export report for subscribers. Jay has traveled and worked with grain buyers in over 46 countries. Jay is an emeritus member of NAGA, North American Export Grain Association, Contracts and Arbitration Committee, and continues to serve as an arbitrar with the North American Export Grain Association. Jay, I'm going to hand it over to you.
Thank you, Caleb, and thank you to all the friends at U.S. Grain, at the USGC Grains Council for the opportunity to talk to you today. Let's make sure everybody can hear me, and I'll pull up that presentation. Let's go to... And Caleb, help me since I lost my picture of you guys. Is the presentation, full presentation showing on your screen?
No, sir, we could only see your face.
Oh, no. That's a terrible thing. Let's get over and see if we can pick a different screen that'll give you a better picture than my face. How is that?
We're in business.
Is that good?
Very good.
Okay. Well, we're going to talk, as Caleb mentioned, we're going to talk about the export contracts and what's going on in today's rather complicated market, especially due to COVID-19. As Reese had mentioned, I think the very, very good news is despite COVID-19, most all world ports are operating reasonably well, more or less on a normal capacity. There have been some incidences, frankly, down in Argentina, but then Argentina is always a little bit different. But again, whether you're going from South America, US, North America, Black Sea, we see global grain trade functioning fairly normal, with a few hiccups, mostly due to crew changes on vessels, and as we'll mention here later, a little bit with documentation for vessels and the need to look to electronic documentation as opposed to paper. But if you buy something from the United States, corn, DDGs, other products, you can be assured that our ports are open and operating and everything is flowing fairly fluid. You'll get what you buy. The one thing that I always have to emphasize is when you get a contract from, if you're a buyer and you receive a contract from your seller, please read it. Please go over it. Make sure that you understand the terms and conditions that have been agreed to, because your contract is made up of two parts. And those two parts are, one, the 1 or 2 page contract you receive from the seller. And then in that contract, it is referenced as to what will be the underlying contract. Because that 1 or 2 page contract just isn't big enough. It doesn't suffice to cover all the little details. So you have to also understand and read the underlying contract that applies, depending on whether you have purchased FOB in the United States, or if you have purchased CNF delivered to a foreign port. And contracts clearly spell out the rights and the obligations of both the seller and the buyer. And what has to be understood very, very well is that both the buyer and the seller have rights, and both parties have obligations that they must meet. And we'll talk about that in more detail as we go forward. I mentioned that the read your contract, understand your contract. We have a bit of a legal acronym that we call, sometimes it's called the margin clause. I refer to it as the four corners of the contract, meaning whatever is within the written page applies. Whatever is not, does not exist within the written page does not apply. So pay attention to that and negotiate whatever is necessary for your needs. Everything is negotiable. Now, if you want a pink ship, put it in your contract and the seller would have to supply it. But I just use that picture to emphasize the fact that you can negotiate anything that in the end is mutually agreeable. So make sure you write a contract that meets the terms and conditions of your needs. Okay, we have different types of contracts now, as we just mentioned. We have FOB, the U.S. Pacific Northwest. We have FOB, U.S. Gulf loading. And if you happen to buy an FOB contract, which means the seller is going to supply the grain, and the buyer, you the buyer, are going to supply the vessel. And if you write that kind of a contract, you're most likely to use NAGA, which is the North American Export Grain Association, acronym NAGA. You'll use a NAGA 2 contract. And that has all those underlying terms and conditions that couldn't fit into the seller's 1 or 2 page contract. If you buy a delivered contract, delivered to the Philippines, delivered to Vietnam, Japan, Korea, anywhere, Malaysia, Indonesia, if you buy delivered under either C and F terms or CIF terms, then you're most likely to be referencing a GAFTA contract. GAFTA is the Grain and Feed Trade Association, the Grain and Feed Trade Association, headquartered in London, England. And GAFTA has about 130 different contracts to cover all kinds of different commodities, all types of different origins, and all types of different delivery scenarios. So most likely, if you're going to buy something from the United States and have it delivered to your port, CIF or CNF, you're probably going to use GAFTA 27 or maybe GAFTA 30, but 27 is for full cargoes. If you're buying container shipments as opposed to dry bulk, then instead of GAFTA 27, you're most likely going to use GAFTA 88 or 89. And that contract covers shipments that are containerized. So look at your contract, see which underlying NAGA or GAFTA contract applies, and then read the terms and conditions, the clauses within those contracts. We're going to concentrate on the most common contracts right now. We'll start off by looking, and again, here is GAFTA, as I just mentioned, and we're going to start off by looking at GAFTA 27, a delivered contract, and then we're going to reference that and how it differs from a NAGA FOB contract. So let's start off with GAFTA 27. You've just bought something CNF or CIF, your port in your country. You've purchased a cargo of corn for delivery in June or maybe this month in May. And you'll see that GAFTA is what we call, or delivered contracts under GAFTA are what we call shipment contracts. So if I were the seller and you were the buyer, and I sold you a cargo for May, I would have to give you a bill of lading. I would have to produce load the vessel and produce a bill of lading by the end of May. if that were the contract shipment period stipulated. NEGA under FOB is not a shipment contract. You could have May on a NEGA FOB contract as your shipment time frame, but in that example of NEGA, it simply means the seller must accept your vessel. You have an obligation to supply the vessel. You have an obligation under NEGA FOB to supply the vessel within the shipment dates. And if you do, I have an obligation as the seller to accept your vessel and to put it into the vessel lineup. So your vessel could come in, as an example, on May 26th, and it would fit the contract if it were a May contract. I would accept it, but what if there were two vessels in front of you and you were the third vessel in the lineup? Well, I would accept your vessel, I would put it in the lineup, and I would load it in what we call normal rotation. But after I load the other two vessels, it might be June 5 before I actually get to your vessel and load it. And so I could legally and properly give you a June 5 bill of lading on a May shipment contract under NEGA, under FOB. Not to confuse you too much, but going back now to GAFTA, under the GAFTA delivered contract, the seller would be obligated to give you a bill of lading in May if that was the shipment period stipulated. As we get into COVID-19 and as we get into other situations that make it difficult sometimes to meet a time schedule, difficult for the seller to meet a time schedule, GAFTA, sticking on GAFTA 27 for the moment, on the delivered contract, GAFTA has a clause 11, and you should read that clause carefully. And that clause in that GAFTA 27 contract states that the seller has the right to declare an extension of shipment of up to 8 days. So if I had sold you this contract for May under GAFTA 27, I would have to notify you prior to the last day of the contract shipment period. So in this case, prior to the last day of May, that I wanted to declare and exercise my right under GAFTA clause 11 in the 27 contract. If I did that, you would have to accept. You'd have to say, Jay, yep, you declared the extension. I have to give you up to 8 additional days to provide a bill of lading. But if you read the clause carefully, you'll also see that it has something else very interesting. And that is the buyer has the right to discount the invoice, the contract price on the invoice, by a certain percentage, depending on how many days I used as the seller, up to a maximum of 8. So keep that in mind, and on this chart you'll see that if I'm 1 to 5 days late, 1 to 4 days late, you can discount my invoice by 1/2 of 1%, 1/2%. 5 to 6 days, 1%. 7 or 8 days used of that extension time period, you can discount my contract invoice by 1.5%, because I am going to be most likely to invoice you for the full amount of the contract and then see if you are sharp enough to discount my invoice when the payment occurs. What happens if I go, as the seller, what happens if I go beyond my 8-day extension? Well, in that scenario, it's negotiable. GAFTA 27 doesn't give any extra days. So it's negotiable, and you would have to negotiate with the seller what you mutually think should happen. But it becomes an important discussion, and it becomes one you should not be having on day 8. You should be keeping in close contact and having an understanding of just how many days are going to be used. I'm not going to spend a lot of time because it would take a lot of time, but you also have to read GAFTA Clause 12, which it also comes into play on these extensions about the extensions and whether or not, how quickly you, the buyer, can declare me, the seller, in default, because it has an appropriation time that also applies. So read your contract carefully and understand those 2 clauses as well as the others. You don't want to, if you look at the bottom, the 3rd bullet point I have on this chart, you don't want to be in the unfortunate situation of declaring the seller in default prematurely, because the seller could then declare what we call anticipatory breach. You have to give the seller every opportunity to act within the time period they are allowed before you can take any action. So, Clause 21, prevention of shipment, lists those clauses, those causes of why is it that a seller might not be able to ship. And we refer to this clause, I guess, more or less as the force majeure clause. And you'll see here prohibition by government, blockade, terrorism, hostilities, strikes and walkouts. You'll see fire and other things that are considered to be an act of God. Now, there's 2 important things. There's actually 2 or 3 important things about this clause. When in GAFTA, if I'm the seller and I declare to you Clause 21, and I send you an email or text, and I say, force majeure, I cannot perform, I cannot execute the contract properly. What do you do? And the answer is, first, you read your contract, and then you ask the seller why. What is the reason? What is the cause that has come up that does not allow you to meet your contract obligation? And that cause has to be something that is listed here, has to be something that is more or less an act of God, something that is not caused by me, the seller. I cannot have anything to do with the cause myself. If I have caused the event, if I have caused the difficulty in execution, I cannot legally declare force majeure. It also must be something unforeseeable and unavoidable. Now, I mention this because in today's world of COVID, we have to think carefully. And there's been a lot of discussion in the grain trade, especially over in the European side with the GAFTA trade people. And we've had actually a similar conversation in our NEGA contracts committee. What about a contract for May shipment that was theoretically or actually written in December? Well, in December, it could be argued that when we entered into this contract in December for shipment in May, we did not know that COVID-19 would be a big problem. We did not know that the causation that was created would logically occur. It was not foreseeable. However, if we wrote the same contract in April or even March, if we wrote the contract for May shipment in March or April, it will be trickier for a seller to declare COVID-19, some COVID-19 related incident that prevents shipment, because it could well be argued, and this is a matter of opinion, it could well be argued that COVID-19 in March and April were known. They were not unforeseeable. And therefore, the seller, when they made that contract, should have taken those issues into consideration. And by making the contract, is more or less stating that, yeah, even with the COVID-19 situation, I think I can execute. Now, there's going to be lots of black and white, and there's going to be a whole lot of gray area to that as to what can be argued, what was known or unavoidable, what was anticipated, what changed from the time the contract was entered into until the time the contract was executed. So be on your toes, read the contract, stay in close communication with your seller, whether it is dry bulk or container, and keep these things in mind. I think as both sellers and buyers, we all have to be aware of this. And force majeure, financial hardship is not a valid excuse for force majeure, nor is it a valid excuse for clause 20 under NEGA. So just because something becomes financially inconvenient or difficult is not sufficient excuse to walk away from your obligations. So keep that in mind also. I think we just covered most of these things, and what I want to emphasize next is if somebody declares GAFTA clause 21, if a seller declares force majeure on a delivered contract, ask a lot of questions and find out what the seller must justify that action. You cannot just declare it, you have to justify the rationale, the reasoning for that. And also say, what does my contract read? If my contract reads, well, this is CNF Vietnam, it's delivered Vietnam, and there's a problem in one port, does that mean that the seller cannot provide the grain and the shipment from a different port? Not necessarily. So trouble in one port is not necessarily, or not always, just cause to declare force majeure on a delivered contract when you have other options, other possibilities to ship from other locations on that delivered contract. NEGA, if you buy FOB, let's look at the same comparison quickly with the NEGA contract. With the NEGA contract, there is no force majeure clause. By design, NEGA has a clause 20, which is the inability to ship, and the seller must declare a clause 20 event if he thinks one exists before the end of the shipment period. And it also must be for some proven cause that is not self-inflicted and not financially, just because of financial inconvenience. And then in the case of NEGA, if clause 20 is declared, NEGA forms a clause 20 panel, and that panel investigates the clause 20 event and its declaration by the seller. And if found to be valid, NEGA issues a clause 20 certificate to the seller. If found to be invalid, the seller does not receive a clause 20 certificate. So I think with NEGA, there's a lot more investigation and proof that is executed if somebody declares clause 20. Much different than the force majeure type clause in GAFTA. So again, you can see in the NEGA contract, the riots, strikes, impediments to unusual impediments to transportation, and then the importance of the seller obtaining a Clause 20 certificate from NEGA justifying the cause. The other thing here that I think is important, particularly when we look at NEGA, contracts written in the United States under US civil law, as opposed to contracts written by GAFTA, which fall under English law. But under US law, NEGA contracts are deemed to have been written in New York, in the state of New York, and they come under New York state laws and the Uniform Commercial Code. And that code, UCC 261 and 2615, deal with something that is called the doctrine of impossibility. And the doctrine of impossibility, to oversimplify it, I guess, just simply follows what it implies. Is it truly impossible for the seller to perform? Again, must be unforeseen, must be regardless of financial hardship. And again, we would have to see, you will notice, if you're thinking about what we are discussing, that under those causes listed under NEGA for Clause 20, pandemics and health issues are not listed. If you look at GAFTA and force majeure, the causes that are listed do not include pandemics. This is rather new. We haven't really run into a situation where people have had to consider a pandemic or a health issue. And I think there's going to be a lot of, I'm pretty darn certain, there's going to be a lot of argument as to, does the COVID pandemic situation truly create a valid reason and an impossibility to execute a shipment or not? And that's going to depend on civil and government regulations that come into play and other issues. So it's going to be argued back and forth. It's not quite at all black and white. So what do you need to do knowing what we have just covered? And I think, or what can you do versus what is maybe beyond your control? My recommendation is read and understand your contracts and your underlying contract, NEGA or GAFTA. Question anybody who tries to declare NEGA Clause 20 or GAFTA Clause 21 force majeure. Question it, figure it out. Is it valid or is it not necessarily valid? Keep in very close communication with your seller. Know if you're getting close to the end of a shipment date. Know if something is going to be late. Don't wait until the last minute and have a surprise. And then documentation. The one thing I also see happening, not only with COVID, but just with the evolution of our industry, but COVID has certainly contributed to this evolution. And that is the need to utilize electronic documents. So we are beginning to see electronic bills of lading. We are beginning to see electronically issued phytosanitary certificates. So make sure that you are cooperating with your local authorities in your country, that you are able to receive electronic copies as opposed to hard originals. And you are able to present that for customs purposes and other purposes so that the shipment can enter the country and not be held up. So again, I think this, we will see a faster evolution to the use of electronic documents, and we need to prepare and be ready for that. We covered this again, which is know your rights, know your obligations, and communicate, communicate, communicate. Look at the GAFTA or the NEGA website where you can find the contracts. If you don't have a copy yourself, They are available on the respective websites. You can view them, you can print them off, you have access to those. If necessary, you do have the opportunity to go to arbitration under NEGA or under GAFTA, and you should have that included in your contract. And if you get into an argument that cannot be mutually resolved, although you should always take every step possible to resolve something and avoid arbitration, but if necessary, that outlet is available. If two parties get in a dispute, they just cannot settle, you do have the ability to arbitrate. But know that arbitration is a little bit expensive. I would not, personally, I would not arbitrate anything under $100,000. It would have to be north or in excess of that amount before I would personally consider arguing something through an arbitration process. And it's going to take, logically, 5, 6, 9 months under NEGA, and it's probably going to take 6 months to a year under GAFTA from the time you file an arbitration until you receive an award, a final award. So I hope I haven't gone over, but there's a very quick rundown of some very technical and somewhat complicated issues, but thank you for your attention. I hope that's off screen share now.
All right. Thank you, Jay. There's definitely a lot to consider there and think about. Before we begin our final Q&A session, I do want to take the time to thank all of our men and women in agriculture who continued to work during the pandemic, those who kept the global supply chain open so we could all have food on our tables without disruption. It's very important, very important. I am going to move us along right into the Q&A portion of the program. I'm going to invite all of our panelists back into view, and I will direct questions accordingly. We will have time for around 10 or 12 questions. So if we do not get to a question that you have answered, we will try to answer those in a later form. All your questions are important, and I appreciate the volume of questions that this group has produced over the last hour. We'll start off, and I'll unmute you guys as the questions come your way. We're going to start off with a question for Reese. Reese, you mentioned 5% parts per million levels for some toxins. Is this for corn or is this for finished feed?
It's a good question. Excellent question. So what you need to look at in those, maybe I can actually share my screen very quickly on this. If you don't mind, Caleb, so I can bring one of these slides up, because I think that is a really good question. When we look at, I want to look right here, for instance, when we look at fumonisin, and let's look at this 20 parts per million right here. When we say less than or equal to 50% of the diet, we're talking about the finished feed. So in the finished feed, each ingredient must, well, 50% of the ingredients must not exceed 20 parts per million. So you're looking at a finished feed, but keep in mind that this 50% is not always the case. Sometimes it's 20%, and then there are other times where it's even 40%, like you've seen here. So just always look for that percentage, but that percentage, yes, is talking about a finished feed.
Great, thank you, Reese. Our next question is going to be for Brian. along the same lines here, Brian, can we include fumonisin in our DDGS specifications? Or is
Yes,
it only
most definitely.
applicable to corn? Are there any costs involved?
Yes, most definitely. This can be included in your required specifications. Just at the time of negotiation or at any time in conversations with whomever your supplier may be, this is a test that can be added at, I believe, virtually all laboratories, independent laboratories that are utilized for the grain trade. Cost-wise, generally, I believe this is a common toxin. So generally, if it's requested at the time of the analysis, it should be just kind of a group packaging. Individual costs are going to vary lab to lab, so it's difficult to really specify what give a firm number. But generally, it's not more than I would say like $45 to $50 for an independent test on that.
Great, thank you. Yeah, if you guys have specific questions on adding anything to your contracts, definitely contact Brian and Tyler, and they can get you those specific answers cost-wise. Tyler, we're gonna move over to you, and in your presentation, you mentioned river locks. Can you please explain briefly what river locks are, and when we're working on river locks, what does that mean?
Sure. It might be easiest to Google a Mississippi or Illinois River lock and dam to see the picture, but what they essentially do is regulate water levels to ensure that rivers don't get too high or too low, to ensure that barge traffic can continue to operate. And these, they're like a dam, and the dam, is met with constant pressure from the river, so they need maintenance every so often. And the maintenance on the Illinois River for 3 or 4 lock and dam locations is scheduled for this summer. So that just means that, again, any elevators that are north of that maintenance will not be reachable with barges. And so then the river system is forced to source grain from other locations that aren't located in that section of the river.
Very good. Thank you, Tyler. Jay, we're going to move the next question over to you. What if a delay is more than 8 days? What will the penalty rate be?
Well, first, the clause has to be declared before the delay. It has to be declared before the end of the contract shipment period. And then secondly, if it goes over 8 days, it's up in the air. It's totally negotiable. So if it was a contract between me, the seller, and you, the buyer, and I go over 8 days, you have the right, if you're careful, if you read your contract, you have the right to declare me in default. You have to wait a few extra days to do that, and that comes under GAFTA Clause 12, appropriation. But if you read those contracts and I'm over my 8-day extension period, I'm the one, the seller, that's in trouble. I should be contacting you and begging you, please give me another day or two. But it's a negotiation, and the seller, the buyer at that point is what we might call in the driver's seat. The buyer gets to make decisions on can the buyer give the seller a few extra days? If you can, do it. And you declare what the discount will be. You negotiate that. If you can't, now this is where the rights and obligations come in. The buyer has to determine, can I go a few extra days? If I can, I should be a good customer and I should cooperate with the seller. But if I'm risking my business, if I'm risking financial harm to my business, I have to draw the line where appropriate. So again, it's negotiable, but I would say the buyer is in the driver's seat in that negotiation.
Thank you, Jay. I'm going to stick with you for the next question. Under the FOB contract, the FOB contract, can a buyer claim penalty from the supplier for a delayed shipment?
Can the buyer declare a penalty?
Yes. Can the buyer claim penalty from the supplier for a delayed shipment?
Well, like the answer to most questions, the answer is it depends. It's not clear, black and white. Keep in mind, under NEGA and a FOB contract, the seller does not owe you a bill of lading within the shipment period. The seller has the obligation to accept your vessel and put it into the vessel lineup. So again, if it were a May contract, it may logically be that the vessel doesn't physically load until June 5 or June 6. And that would not be, the seller would not necessarily be in default. And there would be no penalty to the seller under the scenario that, hey, your vessel was third in line and I had to load these other two before your vessel. Now, if the seller truly defaults, is truly unusually late, and is not acting as they should be under the contract terms, of course, then the buyer could declare the seller in default and could send an invoice for damages. And well, they should, but you have to understand the timing of doing that.
Very good. Thank you, Jay. Thank you. We're going to go back to Tyler for a minute. Sorry, Jay. We're going to go back to Tyler for a minute here with the question, do you have experience shipping number 3 yellow corn to markets, and particularly Asia? Are there safeguards in place that quality will not be less than number 3?
Yeah, great question. Yes, we do have experience. Japan is the biggest market for number 3 corn, and we ship a lot. The U.S. ships a lot to Japan, and Cargill does as well. The safeguards are the same as safeguards for number 2. We have an independent lab. We have a government agency, which is unbiased, doing the grading. And then we have certain pieces of equipment at the export facility that can ensure that we load the grade that we sell. So if the BCFM is too high in the barges, we can clean it. If the moisture is too high, we can dry it. And if the damage is too high, we can reject it and find different corn. But there are multiple safeguards in play, and it's no issue. We've never had a problem.
Very good. Seems like there is some opportunity for number 3 out here in Southeast Asia. That's very good.
Yeah, and just one point on that. If you can consider number 3, it's not so much of an issue out of the U.S. Gulf, but the cheapest corn I think in the world right now is P&W number 3 grade. And so if you have the opportunity to use that for your business, that's where you should be looking.
Thank you for that, Tyler. We'll stick with you on corn. So we all understand that U.S. corn typically is delivered at higher moistures than South American corn. You're 14.5%. Is this export quality the same as the traded quality domestically?
No. I think so. In the eastern U.S., the domestic feeders take 15, sometimes up to 15.5%. I think depending on which ethanol plant you're talking to, they can take higher moisture. Western feeders are more 14.5, but 14.5 is the lowest grade of domestic or export that comes out of the U.S. Nobody buys lower than that.
Very good, very good. I think that highlights the point of the importance of handling and storage on corn and even higher moisture corn. The ability to handle higher moisture corn if the equipment and handling processes are in place.
Yep.
Very good. Reese, we're going to go back to you here. Can you explain, this is a hot button topic, can you briefly explain why is there so much color variety in DDGS? Is this variation bad from a nutrient standpoint? And then we'll have you answer that question, and then we're going to turn it over to Brian and Tyler for part 2.
Sure. I can answer that fairly quickly. To answer the first question, why is the color different? A lot of that is going to have to do with the technology and the processes that they're using in ethanol plants. That differs around the country. Everybody has a little bit different technology. But to say that the Hunter score or the color has any effect on the nutrient value is simply not the case. You cannot tell anything by color. It does not really determine anything as far as a nutrient profile. Please always inspect your DDG. There will be times where you may receive something that has a nice golden color that maybe doesn't have the nutrient profile you're looking for, whereas there's one with a darker color that may indeed have that nutrient profile. So the Hunter score really has nothing to do with your nutrient profile in your DDG. Always test and understand what you have so that you can include it in your rations effectively and efficiently.
Great. Brian, could you elaborate a little bit more on this topic?
Yes, to speak on the color levels, to speak about the technology, each ethanol plant is independently running, and they're called an ethanol plant. They're not a DDGS plant. So their process, their approach is to ensure that they are converting that corn to ethanol. So as it goes through their process, we're going to see definite regional differences in the quality of corn. As Reese had highlighted throughout that corn quality report, you have a vast range of inbound corn quality that you're going to draw from, whether it's a plant in Wisconsin versus Iowa, Illinois. There's going to be a very significant difference in a 100-kilometer radius. And that seems to be about the standard draw area for the majority of the ethanol plants in the U.S. So as they're bringing that corn in and grinding it, whether they take higher moisture corn or higher BCFM corn, as that goes through that process, they do that conversion. This still at the end goes through the distillation stills and all of that, and at the end it still goes through a drying process. And those drying temperatures, whether they are a ring dryer or just the application of the heat is varies amongst all of the production types. And I cannot recall the range of temperatures right now, but it's vastly different in how much time it'll spend in those dryers.
If you can stick with me here, Brian, this is another question. Have you seen any trends of lower lysine levels in DDGS, just from a trend standpoint?
I could not speak specifically to the outbound nutrient profiles related to lysine or the other amino acids. I would go back to the regional corn quality reports and probably have to do a more specific deep dive into look at what origins you're purchasing from and try and do a determination of it. Is it a regional impact? Is it an impact of the conversion factors that with the enzyme applications that ethanol plants are utilizing to realize more gallons of ethanol from less bushels of corn?
Very good. Does Reese or Tyler have anything to add on to those trends in lysine and DDGS? Okay, very good. Jay, we're going to go back over to you, and I'm going to try to deliver this question as purely as possible. Vessel owners have been attempting to include COVID-19 clauses into the charter parties. Is there an official revision of COVID-19 in NEGA or GAFTA have there been revisions in NEGA or GAFTA to include COVID-19 or pandemic clauses in reaction to the current situation?
The basic answer to the question is no. So neither GAFTA nor NEGA contracts have been amended or adjusted in and of themselves to include pandemics specifically. Now, there's a lot of discussion, as the person who asked the question just mentioned. There's a lot of discussion of should a seller put in a COVID-19 statement or clause in their contract, and they probably should, and they probably will be doing so, just like vessel owners. So you can, as we mentioned, you can negotiate anything you wish as long as it's mutually agreeable. But I would expect that you will start seeing vessel owners, you will start seeing sellers include some verbiage of their own in their contracts that addresses COVID-19. But we haven't seen an amendment yet to the core GAFTA or NEGA contracts. No, so no, not in the official contract, but yes, in some contract negotiation terms.
Thanks, Jay. So there is, from a legal perspective, a good answer. I would like to turn it over to maybe Tyler first and then Brian, just to give their thoughts on, from an exporter perspective, an industry perspective, how do you approach these new troubled times and your relations with the customer to make sure you guys are coming to agreeable solutions?
Sorry, my internet was cutting out. So in regards to COVID or just in regards to contract terms in general, Caleb?
We can talk about contract terms in general in your approach, and then COVID-19, maybe if there's anything specific you would like the audience to know.
Yeah, when it comes to contract terms and negotiating, you know, for me, it's pretty simple. There's lots of places to buy corn in the world. And so I always want to find a mutually agreeable solution to issues, because I know there's lots of options, and Cargill's not the only place to buy corn. So it's easy for me to want to come to some sort of solution, and that's always our goal. When there are things like COVID or river flooding or things like that that come up, we'll look at the contract first, but if there's things that are not mentioned in the contract, we want to find some common ground to try to find a solution.
Yeah, I really would just echo those sentiments. And something Jay really spent a lot of time going through in his discussion. Communication is the biggest aspect. You know, just that open dialogue with buyers as to what is being experienced, what challenges you're currently dealing with from a supply standpoint, or you know, just the nature of the market. It's very, very simple to get an update out very quickly to a buyer, or even from a supplier or the general market, just to have an understanding of really how the impacts are. Specific COVID language, that doesn't really seem to be coming into play as of yet, just because contract changes, those take, from a trade organization, take many, many years to get through. They're just not a quick process, you know, with something such as this that has popped up in such a short time.
Thank you. Yeah, it's definitely, I think, you know, the phrase, we're in this together, I think the partnerships are important. The relationships are definitely important. I want to talk a little bit about some trends maybe in the marketplace, non-GMO. So we'll go to Tyler first, and maybe Brian and Reese can all comment about non-GMO corn availability in the U.S. Are you guys trading it? Is it available? Give some insights there.
Yeah, so Cargill does trade non-GMO. It is a growth product for us. We traditionally have traded non-GMO into the Japan market with various partnerships over there, but the U.S. consumer is changing, and there is a desire for more domestic production, more domestic demand. And so we're expanding our footprint, and we do have, it's still a tight market, and it requires some planning to put a supply chain together. But we do have those things in place to build a supply chain to expand if there is additional demand. It just takes that initial conversation about the demand and some planning to put together. There's not much non-GMO traded on an open market. There's a barge here and there, or maybe a train here and there, but it's mostly a specialty crop that's grown directly, in the farm, signed up farmer acres, delivered to an elevator, and then delivered to a facility.
What mode of transportation do you typically, or are you selling non-GMO corn to other markets?
Yeah, Cargill, it's mostly, for Cargill, it's mostly portions of bulk vessels. So a hold or a partial hold, again, mostly going to Japan. And then domestically, we have a few relationships where we sell rail cars, so full trains of non-GMO to a few customers. Then we also do trucks in various parts of the U.S.
Brian.
Yes. The DeLong Company does have a fair history in the non-GMO market, specifically to corn, to food grade corn. We have a very long history of doing the specific farmer contracting, seasonal growing contracts, and we do participate in this market very regularly. But again, it's not on a huge wide scale. We do have a regular export program that goes via containers. We do participate a little bit into the bulk markets via barges, which are we're able to service from our elevator network in northern Illinois and southern Wisconsin. It's one of those markets, so yeah, as Tyler mentioned, it's not a hugely robust market. It's more of a direct contact. Having an idea of what the production is. Really, there's a lot of risk involved with the quality, and then we also experience a wide range of GMO tolerances, and that's one of the biggest aspects that we run into in servicing foreign markets is what are the tolerance levels to GM, and where can we source that from. So that really has blended well to the DeLong Company's network, where it is a containerized grain exporter. The smaller shipments, the quality control aspects, is we're not trying to do a hold on a vessel. We're trying to do it in lots of 25 metric tons. That's just a common approach for us, and we have several elevators that do handle this on a regular basis. Is there anything further you'd like me to expand upon that, or is something that got left out?
No, that's great, Arnold. We appreciate that. Very good. And our Q&A is still open for anybody who needs more elaborated questions. Jay, I do want to ask you another question here regarding contracts, and particularly so a Panamax that has multiple customers and one seller. And the general question is, do the same timing regulations apply to all of the customers? For instance, if the first buyer was loaded May 31st for a contract whose shipments time was full May, but then the second buyer's hold was loaded in June, are they applicable for, is the seller applicable for penalties, or is it by vessel? Can you explain just a little bit about vessel sharing and some of the regulations there?
Well, it can be complicated, obviously, particularly if you have 2, 3, 4 buyers on a single vessel. But rule number 1 is read your contract. And number 2, again, using just addressing the example that was given here, Caleb, by you. If the vessel commenced loading in May and did not complete until a few days into June, you could legally have split bills of lading split by quantity by customer. So using your example, Caleb, yes, customer number 1 could get a bill of lading May 31. Customer number 2 could get a bill of lading June 2. And if there was a customer number 3, he could get a bill of lading June 4. And it would all be, so to speak, logical. It would be a continuous loading of a vessel, and the seller, under those basic terms that you mentioned, would not be in default. There would not be a penalty that the seller would necessarily owe to any of the buyers. Now, if a buyer had a term in their contract that said a bill of lading must be issued by X date, well, that would be different. But under the example you gave, no, it could logically be 2 or 3 different dates and different bills of lading for different customers on the same ship, and no, so to speak, no harm, no foul. And Caleb, if I may, there's 2 issues that I think. One I forgot to mention, and I don't want to mess up. I'm surprised Brian didn't jump on me. In the example in my presentation, we were talking about GAFTA 27 and the extension clause 11 and the up to 8 days of extension time if it is declared in a timely fashion. But I should mention that if you're trading containers and you're not trading GAFTA 27, you're trading GAFTA 88. You're trading a GAFTA container contract. Those extension dates are different. Those extension times are different for containers than they are for bulk. So in a container, you could go up to 14 days in the extension period, as opposed to GAFTA 27 bulk, maximum 8 days. So read your contract, know your terms and conditions. And then one other topic, when you ask about what is NEGA or what else is being discussed from a contractual standpoint, aside from the COVID-19, the biggest topic being discussed by the NEGA committee right now is one safe berth, the one safe port, one safe berth clause in the NEGA contract. And the recommendation has been that all exporters, particularly all NEGA members, design their own clause, their own adjustment to contracts to address the one safe berth, one safe port issue. And that is because of a recent US Supreme Court ruling that ruled against a US seller in the oil business in the way they declared one safe berth, one safe port. So I would anticipate buyers will start to see some change in their contract negotiations vis-a-vis one safe port, one safe berth issue. Thank you.
Great, thank you so much. We appreciate that clarification, and also those insights on those latest developments and hearings. We're coming to the conclusion of our Q&A session and our time. We did have one question that was asked by multiple folks, and it's very relevant to our Vietnamese marketplace, in which I will answer. In regards to circular number 4, the new feed regulations surrounding lead, arsenic, aflatoxin B1, and salmonella testing for products destined for the Vietnamese market. The U.S. Grains Council has been engaged with MARD on this regulation. The MARD has opened up a time for comment from you, the industry, in which we encourage you to put forth your concerns for the ultimate implementation of this regulation, especially during the times of COVID-19 and the pandemic. We are prepared, and we have offered as the U.S. government and as U.S. Grains Council to support MARD to come up with and to implement responsible feed safety regulations. However, it is up to you, the industry, to provide comments back to MARD, expressing your concern with some of the issues that may have discrepancy within them, including the regulation on testing itself. It is our understanding that testing under the current regulation from the United States will not be recognized in Vietnam. These labs must be recognized by a PPD authority, and no such labs exist in the United States. So please, again, we encourage you to reach out to MARD and express your concerns, but also know that we are ready to help in any way we can to make sure the feed and ultimately the food in Vietnam is safe for everyone. With that, that's going to conclude our panel discussion and our program for today. We thank everyone for your participation, and we thank you for choosing US Ag as your preferred partner. Please do not hesitate to reach out to any of us here at the Grains Council. We are available for any questions, any support. We are here for the support of you, our friends and customers. Stay safe, everyone, and have a good trading day.
Bye, friends.